Hi, everybody. Welcome back to another edition of Profit Matters, where we talk about your profit and why it matters. Ashley, how are you?
I'm doing good, Derek. How are you?
Good. We were talking about technical issues here a moment ago. I know how frustrating that can be. But we want to talk today. By the way, I got my new studio is done. I know the background still looks the same, but I actually completely rebuilt this studio and did some pretty cool stuff. So I finally got moved back in here 2 days ago. So I'm excited to, I think this might be my first recording in here.
So fun. I think any changes we make in our home or in our environment feel really good, especially in office space.
And I'm going to say I can write this off, right?
Yeah, you can, of course.
I mean, this is my office. This is my studio. I actually put in the whole, this is my virtual whiteboard over here. I set the whole, we soundproofed this whole thing specifically because I'm doing all these recordings, right? So I needed a good quiet space. Well, let's talk about revenue recognition. That was a topic that we have been talking about getting here on the show, spending a little time dealing with. I guess first and foremost, what the heck does that even mean?
So here's the number one thing I'm seeing when business owners are trying to read, use, or understand their financial statements.
Okay.
They look at their profit and loss or their balance sheet and they say, oh, it looks like I made money this month, but really they're cash poor. They haven't really made any money and they can't understand why or what's happening. And so here's what happens with revenue recognition. When you were on accrual-based accounting, when you record your invoice, if I record it today for December 15th, it goes on my books as December 15th.
Right.
But what GAAP says, or accounting, I guess, rules, if you want to call it, says is what we need to do is we need to match our revenue and our expenses. So if you're a manufacturer, that means when I manufacture a product and that cost hits cost of goods, the revenue for the same thing needs to hit the revenue item. If I'm in construction, the labor for a job needs to have the revenue for that labor also on the P&L in the same period. So when I look at a P&L, no matter what business I'm in, we have some painters who are clients of ours. We love you guys if you're listening. And so these guys, if they're painting a house, they need to have the revenue be in the same month as the cost of paint and the labor to paint it. Does that make sense?
It does, but how the heck do I do that if December 30, do I just not start any jobs the last week of the month? Is that what you're trying to say?
So here's what we typically see is today you pay me, you say, hey, shoot me an invoice for this painting job over at my house. We'll use that as an example again. So you shoot me an invoice in your QuickBooks that's dated December 15th, okay? You're not supposed to use dates on these kinds of shows.
Especially now it's an end of the year one. That even really jacks it even further, right?
But let's say you send me an invoice for December 15th. You record the revenue because you send it to me. It's dated today. And even if I pay it in a future date, it doesn't matter because QuickBooks on accrual thinks, okay, today is the day that you invoice it. And so I pay the $5,000, let's say, and you have $5,000 in December. But really, my contractor comes out and does a job, or your contractor comes out and does my job in January or even February. So now if you just had your P&L, like nothing else happened, let's say you're a brand new business, your December profit and loss or your income statement, that shows $5,000 in revenue. And you go, I made $5,000. Cool.
Oh, because the costs aren't in there. I got it.
Yeah, but then in January or February, when you come out to do the job, what you do is you record the $3,000 that you paid the subcontractor to come out and do the job. Okay, and you don't have any other work, let's say, that comes up in January. Let's use that as an example. So you didn't send any invoices in January. So then you call me up and you go, I lost money. And I'm looking at all these months and it's just so wavy. It's like we make money here, we lose money here. Bank now we don't have money in the bank and no one can understand. And so really the goal of your business should be to smooth the bottom line. So we want to see really consistent numbers across the board, and to do that we have to use the matching principle. We're bidding all of our jobs at the same margin, and then we're matching the revenue and cost. And so we're coming up with the same margin every month when our sales get real consistent, and then our margin at the bottom gets consistent. And if you're thinking about selling your company, They're looking for EBITDA and they're looking for consistency. Buyers don't want to see this up and down. I've got money, I'm out of money, I can make payroll, I can't make payroll. I think that's a real struggle.
Yeah, for sure. I mean, nobody wants to buy a business that they're going to have to dump a bunch of cash into because it's struggling for one reason or another. People want cash flow. That's why you're buying a business. You don't want to have to write the check and then have to put a bunch of cash into it.
Yep. So there's a couple of different ways you can use the revenue recognition criteria, I guess, depending on what business you're in. So if you're a residential home builder, this is a secret today, you can save a ton of money in taxes and have a P&L that really shows you what's happening if you use the completed contract method. That means if it takes you 2 years to build the house, all of the revenue and expenses are on the balance sheet. And the day we close on the house and we no longer work on that project, we move all the costs and all the revenue to the income statement or your profit and loss. It all comes over at once, and we see a $500,000 house with a $500,000 cost, the way the building business is working right now, and you make $0 instead of
yeah, that's pretty much the standard right now, right? Yeah, you just make $0.
Yeah, but that's the way that it's working. You're seeing this matching principle, and so you can use completed contract in residential building. That's allowed by the IRS. In big construction, we like to see percentage of completion. We like to see that in a couple other industries also. And that's where we are recognizing revenue as we have the cost. So let's say we're not getting paid for 1 year. We're still adding revenue to your P&L based on the estimate with the cost. And so we do a lot of that.
Now, your cash flow could be affected by that, though.
Your P&L will not match your cash flow at all. And so this is why it's really important to be looking at your financial statements with your CPA, but also keeping an accurate cash flow. I like to keep cash flow on the weekly basis instead of the monthly basis, and you can really see what's happening there.
Yeah, and it's a good topic to discuss because it is a challenge I think a lot of companies run into is, you look at your books and you expect that to mean that you're financially okay, but you might have a challenge with cash flow. And one of the things I want to chat with you about more in the future, and I know we've talked a little bit about on this show, is just credit worthiness as a business, because that is something that it's not just like you start a business and you go to the bank and say, give me money. Like, they want operating history, they want financials, they have the right to review your financials at certain intervals. It's not just like, all fun and roses. I mean, you got to do some serious work. And if you set up incorrectly at the beginning, then you're going to end up with, and we're doing it right now with a client that I'm associated with, going and doing all of this back work to try to figure out what the heck actually happened, because we want to sell that company, but we haven't properly done the books for a couple of years. And now we don't really know what it's worth. We don't know if it's profitable or not. And that's the challenge. So this is really about setting up and taking good measures early on and making sure you understand the complexities of construction, because I do think that a lot of people and even accounting firms don't completely get construction. One of the things I'm dealing with right now with one of the construction companies I work with is what we call all-in contribution margin. And it's a little different than anything else because we get rebates. And we pay rebates because we're a middleman. So we get rebates from manufacturers based upon certain intervals, but then also our clients, if they hit certain tiers, we're paying rebates. So how do I ever really know how much I made until it's the end of the year and we're doing all the settlements, and then we go, we didn't make any money on this. So those are complicated things to do, and that's why it's important to have an accounting firm involved.
That's right. Yep.
I love it. All right. Well, let's continue on. I mean, we're getting close to Christmas, so I think we're going to have one more. Well, our next episode will be, I think, after Christmas. So, happy holidays and all that kind of stuff to everybody listening. And if you've got questions about your business, particularly if you're in construction, if you're in franchising, if you're in legal, reach out to us at profitmatters.co. We have a ton of expertise in these very specific areas, and we are here to help. What else?
Thank you, Derek.
You got
Merry
it.
Christmas.
Merry Christmas. I know. Happy New Year. Well, we'll have one more before New Year. Maybe we'll record one so we can get this end of year, get your tax shit ready. So
Great.
All right. Well, everybody, thank you so much for tuning into this episode of Profit Matters. And until next time.
Thank you.